$1 trillion in benefits will be paid out to about 65 million people in 2020. So where does all that cash come from? Social Security is financed through a dedicated payroll tax. Like we said earlier, every working American pays 6.2% of their wages to the government on everything they earn up to $137,700. Employers match that amount, or if you're self-employed, you pay 12.4% into the Social Security Trust Fund. All of Social Security's payroll taxes and other sources of income are deposited into this fund, and all the benefits and administrative expenses are paid out of this fund.
Think of Social Security like a pay-as-you-go type program. Benefits being paid out today mainly come from payroll taxes collected from today's workers. Now, for over 30 years, Social Security was flush with cash. It took in more in payroll taxes and other income than it was paying out in benefits and expenses. And the fund didn't just sit there.
By law, income to the trust fund must be invested on a daily basis. So they did just that. Income to the fund is invested in interest-bearing Treasury securities, earning an average interest rate of 2.5% in 2020.
Every dollar of the trust fund is invested in United States Treasury securities. They're special securities only designated for the Social Security Trust Fund, and that actually gives them advantages over regular Treasury securities. U.S. Treasury securities are considered the safest kind of asset to back any claim that you have. And so at the moment, they're held in an extremely safe, although low-yielding kind of investment.
As of the end of 2019, the trust fund was up to almost $2.9 trillion.
At the moment, the trust fund is very near its all-time peak in terms of dollars. It's not near a peak in terms of how many years of benefit payments can we afford to spend out of the trust fund, but nonetheless, it's at a very high level at the moment.
But here's the thing. Since 2010, the payroll tax hasn't been enough to cover benefit payments for the massive baby boomer generation that started to retire. In 2016, the deficit of $75 billion was covered by the interest earned on the trust fund. In 2019, interest covered almost $81 billion of benefit payments. But starting in 2021, living off the interest won't be enough because people are living longer and millions of baby boomers are retiring. Social Security will have to start to draw down from the trust fund itself to help pay for benefits. And even that fund won't last forever. Experts predict the reserves could run out by 2035, at which point Social Security would only be able to pay about 79% of promised benefits. And all the while, any chance at earning any sort of return on surplus money coming into the fund is virtually lost.
The reality is today, every dollar that goes into Social Security immediately goes out the door to current retirees. It never has a chance to earn a positive rate of return over time. And that has really negative consequences if you look over decades of not being able to invest the money that is set aside. When you look at pension programs, about 2/3 of the assets in there are actually investment returns. And so you're stripping that opportunity away from workers.
The worldwide pandemic has complicated things even further. Massive unemployment, a recession, reduced earnings, and lower interest rates thanks to the Fed could all speed up the erosion of the fund. Data from the Wharton School at the University of Pennsylvania estimates the funds could run out as early as 2032. And the Bipartisan Policy Center, a DC think tank, says the reserves could be depleted by 2028. This doesn't mean that Social Security will have run out of money completely, but it does mean that they'd only be able to pay out a portion of the promised benefits. The Social Security Administration declined to participate in this video.
Now, what does this mean for you? Many policy experts agree that federal lawmakers are going to intervene to solve the shortfall before the agency has to resort to cutting benefits. One such plan is called the Social Security 2100 Act, which includes some tax increases while avoiding benefit cuts. And that's just one of many options that Congress has at its disposal.
You can either raise taxes or you can reduce benefits. And then there's little things along the sides that you can do.
You could increase the payroll tax rate. You could also increase the wage base that those payroll taxes are applied to. So rather than subjecting the only earnings below a certain taxable maximum are subject to the payroll tax. You could subject earnings to a higher cap, or even all earnings to the payroll tax rate. Could just do a flat reduction in benefits. You could also increase the retirement age.
President-elect Joe Biden wants to expand the program, meaning bigger benefit checks to the Americans who need it most. His plan to make that happen? Higher taxes on the wealthy. He wants to apply that Social Security tax to earnings over $400,000. It is worth noting that this is a bit of a reversal for Biden, who has advocated for possible benefit cuts in the past. There's another option that involves no policy changes at all, adapting how the fund invests its money. Yes, there's more risk, but the rate of return on Treasury securities can't compete with the kind of returns you'll see from money invested in the stock market. In 2020 so far, even amid a worldwide pandemic, the S&P 500 is still higher today than it was on January 1st.
If we invested in equities now, clearly the Social Security Trust Fund would be exposed to the risk that stock market prices could decline, but on the other hand, they would also enjoy the extra income that occurs because of dividends from stock investments and because of capital appreciation of the shares that are held by the trust fund. But those ups and downs are very minor relative to the overwhelming need for revenues for Social Security.
But the problem with this kind of change in investment strategy? Some say it's too late to make a difference.
If we had changed the investment portfolio back when President Clinton proposed it in the late 1990s, well, it would have made a considerable difference. Now we would have had a much larger trust fund, but we didn't do that. And so if we start now, when the trust fund is expected to be used up over the next 10 to 15 years, it will not make much difference.
If none of these things happen, an outcome that analysts tell CNBC is highly unlikely, then the Social Security Administration says all beneficiaries would get 79% of scheduled benefits.
Universal Social Security has been debated for as long as Social Security has existed. The Heritage Foundation, a conservative DC think tank, put together its own universal benefit plan, one that they argue will flatten out benefits, providing more for people who are below the poverty line.
One of the biggest components that we are recommending is shifting towards a universal benefit program. And so instead of providing the largest benefits to the people who already had the greatest incomes throughout their working careers, and the lowest benefits to those who had the least incomes, it would just be one flat benefit for everybody, regardless of how much you made throughout your working career. And the benefit of this is that it would actually lift about the bottom third of people would get a higher Social Security benefit. And then over time, those who are middle and upper income would gradually shift their benefits down. But of course, it would be very gradual over time, so that many decades in the future, you get to this point where you have the same benefit for everybody. And another benefit of that program, as I said, is lifting more people, the lower income earners, up, but it also can make the program smaller in total size and scope.
One big benefit to this kind of plan? It would actually involve a Social Security tax cut.
We estimate that you could reduce the 12.4% tax down to 10%. The median person who makes about $60,000 per year, they could have an extra, more than $4,000 per month that we're talking about here. And I think it's about an extra $900 for somebody who's making only $20,000 a year. So this is a lot more money that goes into those workers' paychecks.
However, it is important to keep in mind that while this would put extra cash in your pocket today, the onus would be on the individual to actually invest that money wisely. This plan, of course, also assumes that Social Security will still be there when you retire.
But one financial planner that we spoke to says that his millennial clients just aren't holding their breath for a hypothetical like this. Instead, they're trying to plan ahead for a world in which there is no Social Security coming to them in retirement.
Millennials are a generation that face more uncertainty than any other generation before them, so it's no wonder they're asking whether or not Social Security will be there for them. And while we don't have an answer as to how things will look 40 or 50 plus years down the line, we can plan around that level of uncertainty by showing them a number of scenarios as to whether or not there will be Social Security, maybe a 50% reduction in Social Security, or if the system will remain as is.